Monday, November 27th, 2023, Monaco 64, home of alternative economics and contrarian views. Today, we're going to look at the cup and handle formation, or the teacup and handle formation, and what it's done in the gold market historically, and what I think it could be doing today in the present day, of course. And I also want to reference again a pocketbook of gold by Jim Sinclair. I think it's really important for people to know what gold is all about, even though I'm going to be talking about the technical picture for the price of gold. There's something much more important to gold than just looking at the price and trading paper gold, that is. And we're going to look at also what it means, the cup and handle, in terms of fundamentals, in terms of management of perception by the powers that be. And hopefully you find it interesting. Before I do, though, I'd just like to say thank you for all the new subscribers, all the existing subscribers. And if you haven't subscribed, make sure you do. Make sure you hit the like button as well when you enjoy my videos. And try to share it as well as much as possible. And yeah, just wanted to let my UK viewers know, but viewers all over the world could use this as well. Oliver Temple's told me that Gold Investments still has a special on various date sovereigns. It's good till Wednesday this week. It's 5% off the offer price if you use my promo code Monaco 64 SOV. So all the details are below in the description for that. So the cup and handle formation, many of you have heard about that formation, the technical formation. There's a big one actually in silver. It's been forming since 1980. We're going to look at the one in gold right now, though, that's been forming since around 2011. And we're going to look at a historical one as well that took place in the late 90s, early 2000s, which was really significant as well. Right now, if you go back at the long-term charts, you can't even see it because we've gone up so much from those levels. But before we go into that, and I'm not trying to get people all excited, let's jump in, let's buy gold, because hopefully you've been doing it gradually, stacking. Whenever you have some extra fiat savings, you've been accumulating real physical gold and silver as well, for that matter. So yeah, I know I'm going to go over this formation, which looks really encouraging. But first, let's go through what Jim Sinclair says in his pocketbook of gold. And this is from chapter 1, Why Own Gold? And he actually quotes von Mises here. This is what von Mises said. There's no means of avoiding a final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. And honestly, I think we're going to experience the latter, the total catastrophe of the currency involved. And why is that? Well, because our leaders in the West have no clue as to what they're doing, in my opinion, fiscally, monetarily, and they're going to drive our fiat currencies to the ground, especially, versus gold and silver, that is. So I'll go through here the first few parts of chapter 1. Jim Sinclair says, gold is insurance. The primary reason to own gold is that it maintains value, especially during times of political, economic, and currency-related crisis. In short, it operates as insurance that includes but is not limited to insurance against political uncertainty and economic disorder, as well as insurance against the whims of central banks and their tendency towards money printing. I think the current environment fits the bill to a T. I'm going to jump. I'm not going to go through the whole part, gold is insurance. I'm going to jump to the second part. And it says, gold allows you to become your own central bank. Although a central bank is supposed to maintain the value and purchasing power of a currency, it has both the ability and the tendency to depreciate the wealth of citizens through excess money printing. Interestingly, while they issue paper money, they also maintain gold as a currency reserve. Well, and we've seen in the last 2 years that the major central banks of the global south, if you want to call them, or the BRICS, they've been accumulating gold hand over fist because, as Jim Sinclair says here, that alone should tell you something. Central banks do not depend entirely on their own paper currency to maintain wealth. They use gold. Why? One reason is because gold offsets currency risk. Through the retention of gold, an individual mimics the function of a central bank and therefore negates the detrimental effects of a central bank running its monetary printing press. So that's very clear there and continues to apply, in my opinion. One other part that I think is really important about gold and holding gold outside the financial system. I'm not saying you should hold all your gold at home. You could have a safe depository that is not related to the banks. This is the part here. Gold does not expose you to counterparty risk. Ownership of gold does not keep you awake at night wondering if your assets are safe in a financial institution that may or not be trustworthy. Gold also provides safety against the fraud, poor management, and failure of financial institutions and companies that may impact your assets. Lately, there has been a lot of that to go around. Exposure to these failures is not optional. If you are a citizen, you are going to pay, even if you're not directly exposed to any financial institutions. You will be charged through taxation, devalued currency, and asset depreciation. So just wanted to put that out there. That's how I see gold. I think this is a difficult pocketbook to get. You might try to get it online. Unfortunately, Jim Sinclair passed away a month or two ago, I think now. And his website is no more, jsmindset.com. So back to the cup and handle. And I drew these cup and handles during the weekend, this past weekend. So I haven't adjusted it for the move this morning. This is Monday, of course, London time. But I think this should suffice. So I'm going to look at the current cup and handle that I think is really important. And then we're going to look at a historical one. So here we go. This is back from 2005. It is a monthly chart. So this cup and handle has evolved over time. It's not something that's going to happen overnight or in the next day or two. That's the other thing about gold. You need to be patient. It's not a get-rich-quick scheme. Gold is safeguarding the wealth that you've been able to save over your working life, or in the beginning of your working life, or at the end of your working life. It protects the value of it. Of course, they've turned gold into a speculative market ever since 1975. But anyway, here's the cup and handle. And what do I think it signifies? Well, I think it signifies price suppression by the powers that be. And someone mentioned once that it's like a cup or a pot of hot boiling water, and it's just, well, it's simmering water, and then it will get to a point where it boils and it will go up. So I think that's what it is. And I've done some measurements here, and if you take the teacup or the cup and handle, and you look at the distance from the top of the cup to the bottom of the cup, you get $933 roughly. It's not an exact science, but it's thereabouts. And you can see here that gold has never closed above 2,000 on a monthly basis. So we've got a very important week this week in terms of that signal. We've only got a few days left in the month of November, and I think the highest closing is somewhere around 1969 or 89. I haven't checked it. I've checked it, but I forgot. That's also important that we make a new monthly closing high. You can check that out yourself. But as you can see, I drew this on Saturday. It looks like it's breaking out of the cup, the handle, and that's really significant. And you can see that it tried earlier in the last couple of years there to get above that handle, and it was negated. But and we're getting to the end of the handle, even though anything can happen. So you add the 933 to the approximate breakout, which is around 2,000. Some might say we need to break out above 2,070. Yes, that's true. That's the all-time high from 2020. But I think this gives you a good measure of where we could go. And it's 2,933. It's very simple. 2,000 plus that distance. Yeah, it could go up to 3,000. It could be a little less. It could be more. So have we got a precedent? And that's why I said we're going to look at another one. Well, this one I think was the same in terms of why it happened. It was price suppression. And why do I say that? Well, GATA, they started looking into this in 1999. And they came to the conclusion that this man here, Larry Summers, who was a scholar, of course, he's an economist, wrote a book about how gold and Gibson's paradox and bond yields are so important, that gold going up signifies that there's inflation. And lo and behold, he was United States Deputy Secretary of the Treasury from 1995 to 1999 under Robert Rubin, who was a Treasury Secretary. Robert Rubin, of course, started his career at J. Aron, the bullion dealing arm of Goldman Sachs. So if you look at this teacup or cup and handle here, look at what gold did in 1996 up until the end of the century. It just went straight down. It had been trading above and below 400 since the early 80s. It was kind of fixed there, you could say, around 400, and all of a sudden it just drops out of bed. And GATA has done a lot of research, and that's when they started leasing gold. The bullion banks started the leasing program. And what does that mean? Well, it's just like borrowing shares of a stock and selling it short. They started doing that with gold to keep the price down, to make sure that interest rates didn't go up, because, one of Clinton's advisors said, I think it was James Carville, that he wanted to be, if he was, he could choose how he would be born again, would be as the bond market. So they knew it was important. They needed to keep gold down. So they created this cup and handle, as you can see here, from 1996 up until around 2004. So it was 8 years. They're long, these things. And there was a handle there as well that we broke out. And eventually it went even above 700, made a correction, and then 4 years later, we'd made a new high above 1,000 in 2008. So here's the calculations for that old cup and handle. So the top was around $420. The bottom was around 252, which is Gordon Brown's bottom. That's when Gordon Brown sold half of the UK's gold reserves, unfortunately. But I think he was working along with Goldman Sachs. Yeah, one of his big advisors, economic advisors, was a partner at Goldman Sachs. And there are rumors that Goldman Sachs was caught short in this leasing game, and he pre-announced the sale, got the price down, and the bullion banks could cover it, Goldman Sachs and others. But anyway, the distance from top to bottom was $168, a lot less than the $933. You add that to 420, you get 588. And as you can see, we actually went to 588 and even more. We spiked to above 700, and it came back down, retested that area, and then it went up again in the next 2 years. So this is the kind of move we could see. The initial move could be to around 2,900 in this day and age cup and handle. It doesn't mean to say it's going to be the top. And of course, all this is probability. I'm not saying it's going to happen, but I think there's a good chance that it will, and it will signify that, you know, the fiat currencies are losing value, that the central banks are going to keep inflating. And I said that during these periods of cup and handle suppression, or even the handle being formed, there is a lot of disparaging against gold. And lo and behold, this little piece of editorial from the FT, which I've talked about many times, is one of them. Going gold. The pointlessness of holding bullion continues to sink in. Editorial written by the FT. I don't know who wrote it. They didn't put the person's name, but this was right around that time that gold was trying to break out above 400, which was a key level at the time. April 16th, 2004, prices of gold was $400.65. And of course, we've seen over the last few years, there's always disparaging editorials or articles in the mainstream financial press. And I would expect probably to see some more of those right now in the near future as gold tries to break out. So there you go. Let's look at the markets then now, see where they are this morning. It's 8:30 a.m. London time. So we got spot gold actually at 2012. So we're making a new high. Let's not get excited about it. Let's just look at it. Well, the high's been 2018 50. The low's been 1998 50. Am I going to say, well, we'll never see gold trade below 2000 again? No, because it could very well do so. But anyway, spot silver is at 24.65. It's up 34 cents, up 1.5%. And I'm going to talk about silver another day this week. I'm not saying silver's not going to do well. If anything, I think silver's going to do a lot better. But silver's breaking out as well, as you can see by this chart here. The high overnight has been 24.83 and the low has been 24.24. The stock market, the Dow futures, NASDAQ and S&P, they're down slightly, nothing to write home about. The currencies as well are pretty much unchanged, except for the dollar. That's down 0.25% versus the yen at 149.04. The dollars unchanged versus the yuan at 7.15. Check out the other currencies. Aussie dollar is up 0.2, just below 66. The dollar is unchanged versus the Canadian dollar, 136.32, and the Kiwi dollar is up slightly at 60.87. Let's go over to the commodities. WTI crude is trading at 75. It's down a third. Brent is down a third, just below 80. Platinum is up $5, trading around 940. High-grade copper is down 1/3% at 382. And last but not least, the Treasury market. We have over 400 billion of supply this week in notes and bills in the U.S. Just to give you an idea, back in 2003, they issued 534 billion in one quarter. So they're issuing now 400 billion in a week. The 10-year yield is unchanged at 4.48. And let's quickly look at the UK gilt market or government bond market. The 2-year yield is at 4.70. It has come up from a recent low around 4.5. And the 30-year is at 4.77, up 2 basis points. So with that, I'm going to wish you all a very good day. Take care. Bye.